Welcome to Griffonomics.
It is good to be back.
Today, we are staring directly at what might be the single biggest bottleneck in the global economy. And for once, we're not talking about a shortage of NVIDIA GPUs.
Right.
We aren't talking about a lack of skilled engineers. We are talking about something much more fundamental.
That's right. It turns out having the fastest AI chips in the world, the H100s, the Blackwells, it doesn't matter at all if you can't plug them in. We are talking about electricity.
The grid is full. It is just tapped out. In major data center hubs, if you want to build a new AI factory today, the utility company isn't rolling out the red carpet.
Oh, not at all. They're telling you to take a number and, come back in 3 to 7 years.
7 years.
Yeah. And in the AI world, where models evolve every 6 months, 7 years is effectively a century. It's an extinction-level timeline for a tech company.
Exactly. And that timeline is the catalyst for today's deep dive. We're looking at Bloom Energy. Now, if you've been following the market for a while, you might remember them as that niche green energy company from the 2010s.
The fuel cell guys.
The fuel cell guys, yeah. They were cool, but maybe a bit ahead of their time.
They were, but the narrative has shifted completely. This isn't just about being green anymore. We are looking at a fundamental pivot. Bloom has transitioned from a sustainability play to a, mission-critical infrastructure enabler for the AI economy.
They've gone from nice to have to we need this to survive.
Precisely.
So here's our mission for this deep dive. We are going to generate a granular investigative report on Bloom's massive Q4 2025 performance, which just dropped. We're going to unpack this concept of a time-to-power moat, and we really need to look at the manufacturing ramp they have scheduled for 2026.
And crucially, we have to look at the risks, because while the numbers are exciting, the execution risk here is incredibly high.
Oh, absolutely. But I have to say, when I saw that stat about the 55 days delivery time, my jaw just hit the floor.
Yeah.
We'll get to that. But that number alone changes everything.
It does change the conversation, but my job today is to keep our feet on the ground. This is a classic high-risk, high-reward scenario. The financial reality is complex, and the leverage on their balance sheet is, let's just say it's significant.
Okay, let's unpack this. We need to start with the concept that is driving all of this momentum. Time to power. It sounds like a marketing buzzword, but in 2026, it's basically the new currency.
It is the only currency that matters right now for the hyperscalers. Think about the traditional grid. If you look at Northern Virginia Data Center Alley or parts of Ohio, the transmission lines are they're congested. The grid operators, the PJM interconnection queues, they are completely overwhelmed.
Right, so you have billions of dollars of capital, these really expensive AI server racks, just sitting in a warehouse because the local utility companies say, get in line, we'll hook you up in 2030.
Exactly, and that capital sits idle, just destroying your return on investment. Enter the Bloom solution, behind-the-meter power.
Behind the meter. I love this term. So basically, you're generating your own power on your own property, and you're bypassing the utility grid entirely. You're cutting the cord.
You are. You're building a mini power plant right next to your server hall. And because you aren't touching the public transmission lines and you aren't exporting power back to the grid, you don't trigger those multi-year federal and state interconnection studies.
I just skipped the line.
You essentially skip the entire line.
And here is the proof point that really blew me away. We have to talk about the Oracle deal.
This was the validation the market was waiting for.
So Oracle needed power for a hyperscale AI factory. They were facing that multi-year wait from the utility. Bloom stepped in and made a commitment to deliver the power systems in 90 days.
Which, by utility standards, is already light speed.
Right, but they didn't do it in 90 days.
No, they delivered and energized it in 55 days.
55 days. From we need power to here is your power plant. Compare that to the 3 to 7 years we just talked about.
It's an order of magnitude difference, and that speed is reshaping the geography of the internet. We're seeing data center developers just abandon traditional hubs.
Yeah, the data is showing a huge shift. I saw that places like California and Oregon are actually losing market share because they can't move fast enough.
Correct. The sources indicate that Texas is poised to capture nearly 30% of the U.S. data center market by 2028. Georgia's growing by 75%.
Wow.
Why? Because they are power-advantaged regions, or they have regulatory environments where deploying these behind-the-meter solutions is just faster. Bloom follows the speed.
So if you can't get power from the wall, you bring your own box. Let's talk about the box, the technology itself. Because I feel like people hear fuel cell and think of, hydrogen cars that never really happen.
Right. The solid oxide fuel cell, or SOFC.
I always feel like I need a physics degree for this part, but let me try to simplify it. It's not an engine, right? There's no...
That's the key distinction. It is an electrochemical process. Your analogy is a good one. Think of it like a battery that never runs out as long as you keep feeding it fuel.
Yeah.
You pump in natural gas, hydrogen, or biogas, and it converts that chemical energy directly into electricity. No combustion, no pistons, no turbines spinning.
Which means it's cleaner and quieter. But for the AI guys, it's about the specific AI moat features. And this is where it gets really interesting, this 800-volt DC standard.
This is a bit technical, but it's so crucial for efficiency. The grid delivers AC alternating current. That's what comes out of your wall socket.
Okay.
But computer chips, specifically these AI GPUs, they run on DC direct current.
So normally you plug into the wall, which is AC, and you have these massive, expensive adapters, transformers, and switchgear to turn it into DC so the chips don't fry.
Exactly. And guess what equipment is also in short supply right now?
Those transformers.
Those transformers. Lead times on high-voltage transformers are over 100 weeks. Bloom has standardized their servers to ship 800-volt DC ready. They output native DC power.
So they eliminate the middleman equipment entirely.
Right. You plug the Bloom server directly into the data center bus. You save money, you save space, and you improve efficiency because you aren't losing energy in that conversion. Every time you convert AC to DC, you lose power as heat. Bloom just skips that loss.
And then there's the battery issue, or rather the lack of batteries.
This is a huge differentiator against, say, wind or solar. If you power a data center with solar, you need these massive battery banks for the nighttime or cloudy days.
Right, which are expensive and a fire risk.
The big fire risk. And they have their own supply chain issues. Bloom provides baseload power. It runs 24/7. It can handle the massive load swings when an AI starts training a huge model and power usage spikes without needing a battery buffer.
It's steady, it's reliable,
Yeah.
and the efficiency is wild.
It is. The traditional grid is maybe 35% to 40% efficient by the time the power gets to you. Bloom is operating at around 60% electrical efficiency. You're just getting more electrons for your dollar of gas.
Okay, so the tech works, the demand is clearly there. Now we have to look at the scoreboard. Bloom just released their Q4 2025 numbers, and wow, it was a very, very strong quarter. This is what we call the Q4 paradox, where the company has been struggling for years to prove profitability, and then suddenly the numbers just align.
Let's hit the highlights. Revenue for Q4 came in at $777.7 million. That's up almost 36% year over year.
And they beat the analyst estimates by a massive margin, $132 million. I mean, that's not a small beat, that's a blowout.
And for the full year 2025, they hit a record $2.02 billion in revenue. But the number that really caught my eye was the earnings per share.
Adjusted EPS of 0.25 cents. Expectations were closer to 0.30 cents. They beat by 15 cents. This is that profitability inflection point investors have been waiting for. They are showing that the business model can actually scale profitably.
And they're actually generating cash now. Operating cash flow was positive, $418.1 million in the quarter. They aren't just burning money anymore. Well, we need to be a little careful with that cash flow number. Part of it is working capital timing, but yes, the trend is positive. But if you want to know what makes this business sticky, you have to look at the services segment.
The services segment, this is the maintenance, right? The O&M.
Correct. Operation and maintenance. They have a backlog of $14 billion in this segment alone.
$14 billion.
That's contracted revenue. It stretches out anywhere from 5 to 20 years, and it's been profitable for 8 consecutive quarters with margins around 20%. This is the hidden gem. Even if hardware sales were to slow down, they have this massive recurring revenue stream from the fleet they've already installed.
That's a serious safety net. But let's talk about how they plan to grow, because building power plants, even these mini ones, is expensive. Bloom doesn't want to own the infrastructure, right? They just want to sell the box.
Exactly. This is the shift to an asset-light model. They learned that holding all these projects on their own balance sheet ties up way too much capital, so they brought in the big guns.
Brookfield Asset Management.
The Brookfield partnership is the catalyst here. It's a $5 billion framework.
So explain how this works.
Brookfield basically acts as the bank. They pay for the project infrastructure, the pipes, the concrete, the installation capital. Bloom supplies the technology. Brookfield owns the asset and sells the power to the customer, and Bloom gets paid for the hardware and that long-term service contract.
That is brilliant. It validates the tech to institutional investors. I mean, if Brookfield, who is very conservative, is putting up $5 billion, They clearly believe this stuff works.
It completely de-risks the sales process. And it's not just financial partners. The utilities are changing their tune as well. Look at the deal with American Electric Power, AEP.
This is the 1 gigawatt agreement.
Right. Historically, utilities hated companies like Bloom. Bloom was grid defection. They were stealing customers. But now the utilities are so overwhelmed they're coming to Bloom for help. AEP is buying Bloom servers to patch holes in their own grid where they can't build transmission lines fast enough.
So the enemy has become the customer. That is a powerful pivot, and it's showing up in the backlog. Product backlog is up 140% year over year to roughly $6 billion. Everybody wants these boxes.
Which brings us to the most dangerous part of this conversation.
I knew you were going to kill the vibe. Here comes the expert reality check.
We have to. We're entering the high-risk frontier. The numbers are great, but if you look under the hood at the balance sheet, there are dragons.
Okay, lay it on me. The debt.
Bloom has about $2.5 billion in cash, which is great, thanks largely to some convertible notes they issued. But they are carrying $1.51 billion in debt.
That doesn't sound too bad on its own. They have more cash than debt.
It's about the leverage ratio. The net debt-to-EBITDA ratio is 6.4x.
Oof, 6.4x.
That is very high leverage. It means they are priced for perfection. There is zero room for error. If they miss a quarter or if margins compress, that debt becomes a massive weight around their neck.
And they're trying to do something incredibly difficult next year. The manufacturing ramp.
This is the execution wall. Their 2026 forecast projects revenue between $3.1 and $3.3 billion. That's more than 50% growth. To do that, they plan to double their production capacity to 2 gigawatts by the end of 2026.
Doubling capacity.
Effectively, they're trying to scale their hardware manufacturing by 4 times over a 16-month period compared to where they were a year ago. That is an acute execution risk. Building a factory is hard. Staffing it is hard. Managing that supply chain, it's a logistical nightmare.
So if they stumble, if the factory is delayed or they have quality issues, the stock, which is trading at a very high valuation, could get crushed.
Exactly. The market has priced this stock at significant overvalued metrics, roughly 20 times revenue, depending on how you cut it. The market assumes they will execute this ramp perfectly.
So what does this all mean? We have a company that has the perfect product for the biggest problem in the economy. They have the partnerships, they have the backlog, but they have to pull off a manufacturing miracle while balancing a very heavy debt load.
That's the summary. Bloom has successfully pivoted. They're no longer a niche green play. They are the emergency room doctor for the AI power crisis. When the grid is flatlining, you call Bloom.
I like that analogy. So what's the verdict?
I categorize this as high-risk, high-reward buy. The time-to-power moat is real. The Oracle delivery proved it. The backlog proves it. But that leverage is dangerous. The cash position offers a buffer, but you have to watch that manufacturing ramp like a hawk.
So don't bet the farm, but don't ignore it either.
Risk defined. Portfolio protected.
There it is. Before we go, I want to leave you with a thought. We talked about these massive companies, Oracle, the hyperscalers going off-grid with Bloom. They're opting out of the public utility system because they can afford to.
Which raises a pretty uncomfortable question.
Exactly. If the biggest, richest energy users leave the grid, who is left to pay for the old infrastructure? Are we seeing the beginning of the privatization of reliable power? If you have the money, you get 99.999% uptime with Bloom. If you don't, you're stuck in the queue with the rest of us.
It's a question of energy equity, and I think we're going to be hearing a lot more about it in the coming years.
Something to think about. Thanks for listening to this deep dive.
Thank you.